Why interest rates are expected to come down in September. An in-depth analysis. As we approach September, financial markets and economists worldwide are closely watching central banks, particularly the Federal Reserve in the United States, for signals about the future path of interest rates. After a prolonged period of rate hikes aimed at taming inflation, there is growing consensus that interest rates will come down in September. This expectation is grounded in several key economic indicators. The inflation trajectory. One of the primary reasons for the anticipated rate cut is the recent moderation in inflation. Over the past year, inflation surged to multi-decade highs due to a combination of supply chain disruptions, elevated energy prices, and strong consumer demand. Central banks responded by aggressively raising interest rates to cool the economy and bring inflation back toward target levels, typically around 2%. Recent data, however, shows that inflation is easing. Consumer Price Index (CPI) readings have demonstrated slower month-over-month increases, and core inflation, excluding volatile food and energy prices, has also moderated. This suggests that the aggressive monetary tightening is beginning to have the desired effect, reducing price pressures without triggering a severe economic downturn. Economic growth and labor market conditions. Another critical factor influencing the decision to lower rates is the state of economic growth. While the economy has shown resilience, growth rates have slowed compared to the previous year. Manufacturing output, retail sales, and business investment have all softened, signaling that the tightening cycle is weighing on economic activity. The labor market, a key indicator for central banks, remains strong but shows signs of cooling. Job creation has slowed and wage growth is stabilizing. This balance is crucial because a tight labor market can sustain inflationary pressures through rising wages. The current data suggests that the labor market is moving toward a more sustainable pace, reducing the risk of wage-driven inflation. Central bank policy outlook. Central banks, including the Federal Reserve, have communicated a data-dependent approach to monetary policy. After a series of rate hikes, policymakers are now focused on assessing the cumulative impact of these increases. The lag effect of monetary policy means that the full impact on inflation and growth often takes several months to materialize. Given the recent inflation moderation and signs of economic slowing, the Federal Reserve is expected to pivot toward easing monetary policy. A rate cut in September would signal confidence that inflation is under control and that the economy can benefit from lower borrowing costs to sustain growth. Market expectations and financial conditions. Financial markets have already priced in the likelihood of a rate cut in September. Bond yields have declined, and futures markets indicate expectations for lower rates. This market sentiment reflects a broader belief that the tightening cycle is ending and that central banks will shift to a more accommodative stance. Lower interest rates would ease financial conditions by reducing borrowing costs for consumers and businesses. This can stimulate investment, support housing markets, and encourage consumer spending, all of which contribute to economic growth. Potential impacts of lower interest rates. If interest rates come down in September, the effects will be felt across various sectors. For consumers, lower rates mean cheaper mortgages, auto loans, and credit card interest, which can boost disposable income and spending. For businesses, reduced borrowing costs can facilitate expansion, capital investment, and hiring. The housing market, which has been subdued due to high mortgage rates, could see renewed activity as refinancing becomes more attractive and new home purchases increase. Financial markets may also respond positively, with equities benefiting from lower discount rates and improved corporate earnings prospects. However, central banks will remain vigilant. The risk of inflation reaccelerating remains if monetary policy is loosened too quickly. Therefore, any rate cut will likely be cautious and accompanied by clear communication to manage market expectations. Conclusion: the expectation that interest rates will come down in September is supported by a combination of easing inflation, slowing economic growth, stabilizing labor markets, and central bank policy signals. This anticipated shift marks a critical juncture in the economic cycle, balancing the need to sustain growth while keeping inflation in check. For businesses, consumers, and investors, the prospect of lower interest rates offers opportunities for growth and financial relief. Yet, the path forward requires careful monitoring of economic data to ensure that the benefits of lower rates do not come at the cost of renewed inflationary pressures.